The world believes it is witnessing a standard oil crisis, fueled by market volatility and emergency government meetings across Europe and Asia. On the surface, the panic is easy to understand. It all centers on a narrow strip of water known as the Strait of Hormuz. This tiny passage is the only sea link between the Persian Gulf and the open ocean, serving as the transit point for roughly 20% of the world's daily oil supply. The general consensus is simple. If this choke point is blocked, the global economy collapses. However, this narrative is incomplete. The real story isn't just about a potential crisis, it is about how global energy dynamics have fundamentally shifted, creating a scenario where a crisis for some is a strategic advantage for others. To understand why this crisis looks different today, we have to look back 20 years. In the early 2000s, the United States was heavily dependent on foreign oil, importing approximately 60% of its total petroleum consumption. During that era, any instability in the Middle East led to an immediate and painful shock to the American economy. Prices spiked, inflation surged, and growth stalled. But over the last 2 decades, new drilling techniques unlocked massive shale reserves within U.S. borders, leading to a domestic production boom. Today, the United States is the largest oil producer in the world. This flip has changed the entire geopolitical script. The U.S. is no longer on the losing side of an oil supply disruption. It has moved to a position of relative safety and even profit. The exposure to a Strait of Hormuz disruption has shifted dramatically toward Asia. While people often speak of a global shock, the reality is an asymmetric one. Only about 2.5% of the oil moving through the strait is destined for the United States. The vast majority, roughly 75%, is headed to 4 specific countries: China, India, Japan, and South Korea. For these nations, a disruption isn't just a price problem where fuel becomes more expensive, it is a supply problem. A price problem can be managed by slowing down, but a supply problem means factories stop running, energy must be rationed, and industrial output stalls. This is where the crisis secretly becomes an advantage for the United States. When global supply tightens, oil prices rise everywhere because oil is a globally priced commodity. While higher prices do hurt American consumers at the pump, they simultaneously generate massive revenue for U.S. producers, exporters, and energy companies. The same event that causes structural economic pain in Asia acts as a stimulus for the American energy sector. The situation becomes even more lopsided when you look at liquefied natural gas, or LNG. The Middle East is a titan in LNG exports, with countries like Qatar and the UAE sending over 90% of their exports through the Strait of Hormuz. This represents 20% of the entire global LNG supply. Just as it did with oil, the United States has quietly spent the last decade becoming the world's largest exporter of LNG. If the Middle East supply is choked off, the U.S. energy giants are the only ones capable of stepping in to fill the void. Markets are already pricing this in, with major U.S. LNG exporters seeing double-digit stock growth as global tensions rise. Scarcity for the world is becoming an opportunity for American energy independence and dominance. If the U.S. is the primary beneficiary of this shift, the primary loser is undoubtedly China. China is the largest oil importer on the planet, consuming up to 16 million barrels per day, with 11 million of those barrels coming from abroad. A massive portion of that flow passes directly through the Strait of Hormuz. China is not blind to this vulnerability. For years, they have been diversifying their suppliers, building massive strategic reserves, and increasing imports from Russia, Brazil, and Venezuela. However, these safeguards are only temporary fixes. They can delay the impact of a crisis, but they cannot eliminate the structural risk. China's entire economy, its manufacturing, its exports, its massive industrial output, runs on a constant, uninterrupted flow of energy. If that flow is restricted for a significant period, the pressure on the Chinese state becomes existential. This brings us to the deeper geopolitical layer of the current energy tension. It is rarely just about the oil itself, it is about the timing. As tensions in the Strait of Hormuz escalate, trade negotiations between the U.S. and China have reached a boiling point. The two largest economies in the world are currently locked in a struggle over tariffs, technology restrictions, and supply chain decoupling. In high-stakes international diplomacy, leverage is everything. Leverage comes from pressure, economic, market, and energy pressure. When viewed through this lens, the Strait of Hormuz stops being a simple story about shipping lanes and begins to look like a tool of geopolitical influence. If one nation can withstand an energy shock while its primary rival faces structural collapse from the same event, the crisis becomes a powerful bargaining chip. The volatility we see today isn't just a malfunction of the global market, it is a realignment of power. The Strait of Hormuz remains a choke point, but it is no longer just choking the flow of oil. It is being used to squeeze the flow of global power. The crisis is merely the surface-level noise of a much deeper, more calculated game of positioning between the world's superpowers.